So I think the first quarter, part of the rally was due to the extreme sell-off in the fourth quarter starting to reverse itself. I think that was exaggerated. So the first 2 months of this year started out quite strong. Almost a straight line rally in January and February, with the market recouping a lot of the losses in the fourth quarter. Broadly speaking, the indices are all up double digits. The NASDAQ has continued to lead, but we've seen better underlying performance from some other parts of the market. The market's started to broaden out. Some of the headwinds that were there in the fourth quarter starting to retreat, the Fed becoming significantly more dovish. You've started to see some companies gaining confidence in their outlook, so they're actually starting to spend more, both on M&A, buybacks, dividend increases. So the market's had a better start to the year. Some of that's related to how significant the sell-off was at the end of last year, and also just a brighter outlook. Even slow growth with low interest rates and an accommodative Fed tends to be a pretty good place for the equity markets if you're investing for the long term. So on a performance basis, we actually had some pretty big winners. Areas like storage, companies like Seagate and Western Digital, which had seen multiples compressed down to single-digit multiples of free cash flow, had a nice rebound during the first quarter. I think the downside scenario is significantly priced in, and we think there's potential for a good second half rebound in data storage growth and storage needs. We've also had decent performance out of some of our software companies, some underlying companies exposed to electric vehicles like Cree, which we've owned for a number of years, which had better performance in the first quarter. So pretty good performance in our tech names. In the software space, Autodesk has continued to be a very strong performer. Across the portfolio, a nice rebound in energy and some of the more commodity-sensitive names. So broad-based performance. The majority of the holdings in the strategy are up, and it's actually been a pretty decent first quarter on an absolute basis. So healthcare has been mixed. Biogen clearly hurt, and a one-day share price decline of over 30% led it to be the biggest detractor within the strategy. And then within media, again, we had some positive performers or contributors like Comcast, whereas we also had some detractors. Some of the pure play programmers, particularly on a relative basis, have hurt. AMC Network, some of the names that are more pure plays on content, have seen their share price basically flatline because of mixed messages around over-the-top video and how that might impact the media sector moving forward. Just more uncertainty that has continued to compress valuations in some of those names. If you look at valuations, they're pretty good. The Fed has obviously become less of an issue. Interest rates have declined about 25% off of where they were coming into the fourth quarter. So the overall backdrop for equities is pretty good, particularly if you have a longer-term time horizon in investing, the way we certainly do in this type of strategy. So a lot that can go right. Like the market, I think that most likely in the fourth quarter, we put in a traditional off-presidential election year bottom. Usually the market rallies from that. We've seen, I think, the beginning of that. I would just say leadership moving forward from this point is probably going to look quite different than it's looked the last 3 or 4 years.